Hello and welcome to the third and final interview in this series, which looks at defined contribution. Once again, I will be your host. And as a reminder, I'm Mark Dunn, the editor of investment magazine Portfolio Institutional. Now, so far, this series has looked at the retirement landscape and integrating ESG. But for this final edition, we'll be looking at something that defined contribution schemes appear to have a growing appetite for: private markets. To find out how important such assets are for defined contribution schemes, I will be speaking with this gentleman here. Could you introduce yourself, please?
Yeah, my name is David Lomas. I'm the global head of BlackRock Alternative Specialists, which is the client part of our alternatives business, helping clients solve their investment problems all around the world. Mark, to your point, DC is definitely an area of growing interest from our clients. I'm looking forward to the debate.
Brilliant. And sounds like I'm talking to the right person about this. So thank you for joining me, David. Now, in an economy undergoing such a profound transformation, these are challenging times for investors. There's been a lot of noise around the use of private assets within institutional portfolios. So could you give us an insight into the role they play and where opportunities lie for defined contribution schemes?
Absolutely. So, first of all, let me start off by saying we are seeing huge demand from the pension community for private markets, including the defined contribution. I think if you look at the market turmoil that you alluded to, the traditional, let's call it 60-40 portfolios that have existed predominantly in the pension space really will have underperformed significantly this year, and have really caused a lot of schemes and organizations to look outside of the traditional asset classes. And that's why we're seeing an enormous demand and appetite for alternatives or private market assets coming into portfolios. So, why is that? Well, number one, the private markets are a significantly more diverse market opportunity set than the public markets. There's probably, there's over 7.5 million decent sized companies in the US. There'll be millions globally that you have the opportunity to invest in. That gives you diversity around sectors, geography, and different parts of the growth cycle for a company. So huge diversity, number one. Number two, until recently, a huge demand for income. Obviously, interest rates rising have cushioned some of that need, but we're still seeing massive demand for income. And we'll come on to that in the context of DC, because I think it's really important as you think about the journey the DC schemes are going to go on with their savers and then ultimately their retirees. The third is return. People are still looking for elevated levels of return to try and grow their saving pots to as optimal a size as possible. And I think as you've seen this year, the demand for portfolio resilience is huge. And the private market assets, if you look at the data going back over a 10-year period, have a lot more avoidance of downside risk, which actually provides more ballast and resilience into the portfolios. And I think what's really interesting, Mark, is the private markets gives you an opportunity to invest in really unique opportunities that just don't exist in the public market. I'll give you an example. We've just closed a transaction with a company called Vanguard Renewables. Now, what is Vanguard Renewables? Well, you can't buy it in the public market, so it's private. 40% of food produced in the US goes to waste. That's either landfill or incineration, which therefore creates carbon emissions and methane into the atmosphere. At the same time, you also have a lot of cow methane, that is cow manure that is producing a lot of methane. So this company has created a solution to use renewable power to take the landfill, take the manure, and to reduce the emissions coming from that waste. And ultimately, very complicated process, what happens is you produce a renewable gas that is used to power homes and businesses. You split out the waste, you create liquid carbon, low carbon fertilizers compared to the traditional chemical fertilizers, which today are very expensive due to the situation going on in Ukraine. And then the clean solids that come out of that process, they're actually using that to create bedding for animals. So from our perspective, really interesting opportunities that you just don't get access to in the public markets. And that's why we think DC should be a participant in these types of opportunities.
Thank you. Thank you. Yes. Given the low but growing uptake in private market investments in defined contribution schemes and the different investment and operational features compared to the more traditional public market investments, what are the key considerations for schemes allocating to illiquid assets?
I mean, first of all, for me, we have a fiduciary responsibility when we're managing money for pension savers. That fiduciary responsibility means we have to think about what the investment return is, what the investment objective, and make sure that we're really driving towards the right outcome for those savers. And so I start from that premise when I think about the solutions. And what frustrates me and a lot of the industry is there's too much focus on fees. And today, when you think about fees, if I was to look at a 1% improvement in return over 40 years and compound that, that is a 50% improvement in the return profile for the saver. And so I think for me, the first phase is we have to, if you want access to these really interesting ideas, we've got to look at that conundrum. And I know there's a lot of work and discussion going on about that, but I think we need to start moving the debate towards what is the net return to the investor. Now, we produce a lot of what's called capital market assumptions. They're a 5 to 10 year view of the capital markets. And what I can tell you is that when I look at the private market return assumptions over that 5 to 10 year period, they are higher than your traditional fixed income and equity strategies. And first of all, DC customers are not participating in that market opportunity set and therefore not getting the opportunity to have those elevated returns. The second part is if you're going to design a solution, you've got to think about the private markets in the construct of the whole portfolio that the customer is invested in. And if you think about a DC scheme, it goes through a savings when you're working phase. As you get closer to retirement, you typically want to crystallize the value and protect the value you've created. And as you come through retirement or into retirement, you want to start drawing down an income. And so private markets, when you think about the whole portfolio, need to form a part of that journey and make sure that the experience of the saver is as intended around savings growth, portfolio stability, and then income generation. I do think you asked about kind of access. I would say the LTAF, which is coming through the regulatory framework, is a great opportunity for the industry to get aligned behind a regulatory structure that will make it easier for DC investors to invest in these markets. So we're excited about that, just to put that out there. But the 5 key considerations that I would ask everyone to think about. Number one, what is your investment objective? As a trustee of a scheme, setting the investment strategy, the fiduciary standard you have is what is a good investment outcome. Number 2, how are you going to build that portfolio? It isn't as simple as putting a bit of private equity, a bit of real estate, a bit of infrastructure, a bit of credit into a portfolio and hoping it works. You have to think about the building blocks and how they work together and how they work together with the liquid part of the portfolio, which will typically be the dominant allocation for a pension scheme. The third is we need to understand the return profile, the liquidity profile, the risk profile, and also the profile of the scheme, so you can design something that will evolve through time to meet the cohort demands of the savers. The 2 final ones, I think, need more airtime, Mark. The first is it is getting more and more competitive to find deals to invest in. So going through the traditional methods of sourcing deals, the public tender process, the auctions, is not the way forward. So anyone that is thinking about this asset class shouldn't look at past performance as a guide to the future. You should never do that. You should look at what's going to be delivered going forward. Yeah. And from our perspective, the sourcing edge with your partners is critical. So how are the managers that you're working with selecting the best opportunities for your portfolio that are coming through what we call the non-commoditized sourcing venues? So they give you the opportunity to find really cool deals. Let me give you an example of one. Okay. We've created a capability with a great partner of ours called Temasek, and we've made 3 investments so far in this growth equity strategy. The first one was a really cool company called MycoWorks. Technically, it's complicated, but fundamentally, think about it. It's replacing animal leather with plant-based leather. So that's pretty cool. So the technology is allowing us to use plant-based, let's call it ingredients. It has similar characteristics as leather, and using that to actually replicate the leather of animals, but with about a 90% reduction in the carbon footprint. When you're using that in high-end luxury goods or the end of the automotive kind of conveyor belt of production, think about seats and so forth, huge potential for the industry to bring innovation to the marketplace. And so for us, that sourcing engine of bringing those deals to market is really exciting. And I'd love that to be in the realms of the DC space. And then finally, sustainability. You are investing for between 10 and 40 years. If you're in a DC scheme, you have to take a long-term view. We believe climate risk is investment risk, and therefore the sustainability agenda is huge and needs to be a key consideration of the retirees' investment journey.
You did mention sustainability there. I mean, what is the role of private markets in the net zero transition, and why is it important for defined contribution schemes to integrate it into their investment process?
Well, number one, the demand from the customer. We did a survey last year of our DC client base, and the age group of 35 to 44, so think about the kind of dominant investor pool, 48% of them have a key concern around climate risk versus 32% of the rest. So the members of the schemes are focused on this topic. I would also encourage everyone to think about not just the climate aspect of this, but the societal aspect. And the millennials, which obviously are the growing cohorts coming into DC schemes, 25% of those are very focused on the societal element versus 15% of the older generations. So number one, there is huge customer demand to address the issues of climate change and societal inequity. Number two is regulation. ESG is being integrated into all pension schemes, and at the end of this year, the DWP states that climate change risk to the 1.33 trillion of assets in pension schemes is going to be assessed. Ultimately, those findings are going to be published, and that is going to increase the scrutiny on schemes around their adoption of sustainability and climate change within their investment thesis. So you have customer demand, you have regulation. So the question is not are we going to be on a route to net zero, but how and by when? And our view is, as I mentioned earlier, that 10 to 40 year view is mission critical. We think there are really interesting opportunities for DC investors in the private markets versus the traditional. We've seen huge demand. So we closed a fund last year that was focused purely on renewables, and we raised over £4 billion into that strategy to meet an enormous demand. And this year we've just launched an evergreen strategy to help solve energy security and independence around the globe, obviously with a bias towards the European market today. But then I look at the transition to net zero. There is a 125 trillion gap between today and 2050 that needs to be funded to enable us to get to net zero. Today, 1.5 trillion is being spent per annum to close this gap, when we need to be spending 4.5 trillion. There is an enormous opportunity set that goes beyond infrastructure. It comes into private equity. It goes into real estate. It goes into the credit space to help companies on this transition. And 85% of savers in DC schemes or DC savers in schemes are in net zero targeted schemes. And I would argue today, Mark, they don't have access to these asset classes because of the original points I made earlier about fees and the opportunity set. So I think we have to unlock the potential. I think we have to work together to do that. And I think we have to make this exciting for the retirees to encourage continued growing participation in the savings agenda we have.
David, that was fascinating. My main takeaway from that is the plant-based leather. Never heard of that before. So that's something else for me to look into. So thank you very much for joining me today and for sharing your insights into what is a very important and growing topic.
Thank you, Mark. I appreciate the opportunity.
No problem. And that's actually it for this series. And I'm sure that all of us speakers have given plenty for those making investment decisions that defined contribution schemes something to think about. So thank you and goodbye.